Hello and welcome to another episode of Financial Ernie. In today's video, I want to break down Mullen's recent 10K that was just filed yesterday. So let's go ahead and jump right into it. This is going to be a little bit more of a lengthy video, so please bear with me. Hopefully you all get a little bit of benefit from this. If you will, drop some comments, let me know your thoughts on this. So let's jump right into the revenue line. So for fiscal year 23, Mullen had a total vehicle sales of 366,000. Cost of sales was 273,882 for a gross margin of $92,118. We'll break down what exactly was in that revenue on the next slide. So the next section I want to talk about is operating expenses. So just looking at what would be sustained operating expenses being the G&A and the R&D. Adding those up and then dividing by 12, you get a better idea about what the sustained monthly loss from operations is going to be. Comes out to $24,436,122. So if you look at the next slide as well, you'll get an idea about what Mullen was able to invoice in quarter one of fiscal year 24. So we'll break that down a little bit more. It looks like they're on the right track to be able to sustain loss of operations. I just need to scale up, in my opinion. So again, I just want to share that this video is not for financial advice. It's just for entertainment purposes only. So bear in mind as we break down this 10K. All right, another section I want to talk a little bit about, because a lot of people are talking about how Mullen's 10K had a total loss of a little over $1 billion. But part of that loss had to do a lot with some of these derivative liabilities. I added to the very bottom of this slide exactly what those derivative liabilities incur. And a lot of this has to do with some of their financing costs. So a lot of those SPAs that were utilized during fiscal year 23, that had a negative impact of the overall company's balance sheet. So again, those had mostly to do with the SPAs. That has nothing to do with the actual operational cost to maintain the business. All right, so on this page, we're going to break down the revenue a little bit more. This is on page F61 of the 10K. And at the top left, boxed in green, you're going to see $308,000 from one dealer. Why do I think that's important? Because that differentiates the fourth quarter sales or revenue versus the Q3 revenue line item. So we know that Mullen sold 22 campus vans to RMA back in quarter three. And I have that broken out here as well. So that was at $308,000 for a gross margin of $59,331. With the 10K information, if we subtract the 10Q, you're going to get the revenue line for the 3 campus vans that were sold, as well as the gross margin line. So you're going to see $56,000 of revenue for the 3 campus vans. Gross margin is going to be $32,787. So looking at those two numbers, you can actually calculate the profit margin. So for the last 3 campus vans, there's a profit margin of 56.53%, whereas when the vehicles were sold to Rainy Marion Auto, there was only a profit margin of 19.26%. So it does look like Mullen Automotive performing a direct sale to either New York Power Authority or British Airways would have resulted in a much higher profit margin. All right, so on this slide, I want to break down a little bit more of the revenue line, and I wanted to talk a little bit about one of the notes that Mullen shared, and this is going to help explain why those 10 Class 3 trucks did not show up in the earnings. So let's go ahead and read along at the top there. Have a box in green. It says, in accordance with accounting standards, we recognize revenue from the sale of electric vehicles upon transfer of control to a customer. In general, the control is transferred at the point of delivery to the customer, but certain contracts, RMA contract, to be specific, with our dealers contain a return provision stating that they may return unsold vehicles after 1 year. Since the company does not have sufficient relevant statistics of returns yet, we defer revenue recognition until the vehicles have been sold by such dealer or until there is sufficient evidence to justify a reasonable estimate for consideration to which the company expects to be entitled. Payments from customers are generally expected to be received within 30 days after delivery. So breaking that down a little bit more, that means that Mullen did receive, and you can see this in the table, Mullen did receive the invoiced amount at the end of the fiscal year there. They got the cash, so they got cash received of $1,018,200. But when it comes to recognizing the revenue on their earnings, they're only recognizing the products that was sold to that end customer. So Rainy Marion Auto purchasing those 22 vehicles for their dealership is why the revenue was recognized there. And these 10 trucks, Rainy Marion Auto is going to have to sell to a customer for the revenue to be recognized. However, they're going to be getting that cash. So if you look down at the second table there, and this is for basically quarter one of fiscal year 24. It ended in December 31st. You can see that Mullen 3s, there's a total of 131 of those invoiced. And then for the urban delivery class 1 vans, there was 100 of those invoiced. So altogether, there was $11,907,320. Cash received, though, they did not receive cash because that last line says that payments from customers are expected to be received within 30 days after delivery. So Mullen should be receiving that cash in January. However, most likely the earnings for this $11,907,320 will not show up until quarter two earnings reports. And that is going to be after these vehicles have been sold to customers. Next thing I want to talk about is the EPA and the CARB emissions certificate of conformity. So one thing that Mullen did share with us, we all know that the Class 1 already received the EPA and the CARB. The Class 3 as well has the EPA. But Mullen shared that the CARB for the Mullen 3 is expected by January 2024. So that's going to be another really good accomplishment to get that certification. There's some additional incentives for buyers, specifically in California, that have that CARB certification. So once that's been approved, speculating here, you should see an increase of demand in the state of California because the end cost of the vehicle to the customer is going to be much less. All right, we're going to go ahead and talk a little bit about the assets and liability. I'm not going to break it down line by line. You can read it through and pause if you'd like. But let's just talk about the boxes in green here. So total assets for fiscal year 23 came out to $421,705,730. Where total liabilities came out at $148,897,620. Why is this important? Because in order to be eligible for an ATVM loan, you have to maintain a 2-to-1 ratio on assets to liability. So as you can see right here, Mullen is very much within that criteria amount. And you can see that if you subtract the two there, Mullen still has a very good amount of assets available in terms of leveraging what they have to potentially get some loans in the near future. Definitely see. All right, another section that's worth noting is cash flow. So you can definitely see at the very top there, net loss was $1,006,658,828. I talked a little bit about this on one of the first slides in terms of loss of total loss, not loss for operations, but the other line item there was a lot of the derivative liabilities. And you can see those listed here. So you've got the reevaluation of derivative liabilities at $116 million and change, and then you've got the initial recognition of derivative liabilities at $513 million and change. So a good chunk of the net loss came again from some of the financing that Mullen took place this past year, and this had to do with the exercise of a lot of those warrants. If you read the first slide there, you can see how they kind of break that down a little bit. One thing that I did want to show, though, at the very bottom, boxed in green, you can actually see the cash and cash equivalents available for the end of 23. So we had an increase from year 22 to 23. Now we're sitting at $155,696,470 remaining there. All right, next thing I want to cover is a pretty big and pretty important piece of information. This has to do with the common stock count as well as the amount of warrants, and we'll talk a little bit about equity compensation plan and what's remaining there. So as of January 12th, 2024, Mullen's common stock total number of shares was at 5,884,693. Quitus, as of the same January 12th, 2024, still holding on to 870,743 warrants. Just wanted to point out that if Equitas was to exercise all of the remaining warrants and add to the common stock amount, we'd still be under the amount for options trading. So still at this time, that has not been turned back on. I want to talk a little bit about the equity compensation plan numbers now. Again, I wanted to point out on August 3rd, 2023 at that shareholder meeting, 52 million shares were approved for this incentive plan. And then as of September 30th, 2023, we got an update of the number of securities remaining. So we have 42,528,111 shares still remaining, and we do know based off of the provisions here that those are immune from the reverse stock split. But Mullen's already placed back 10 million of those shares, as this we know that this took place before the last 1-for-100 split, as this was dated for September 30th. All right, you've made it to the last slide of this video. Before we get started, I just wanted to mention that I will be putting a link to the 10K in the description of this video. So please go ahead and read through the entire 10K. It's rather lengthy, so I just gave a quick overview, my opinion, some of the major things that stood out to me that I'd like to share with you all. But let's talk about this last slide. So risks related to our securities, capital requirements, and financial condition. I'm going to read the bold statements under these couple of items. And then, like I mentioned, if you'd like to read along on your own, please do so. So we have incurred significant losses since inception, and we expect that we will continue to incur losses for the foreseeable future, which makes it difficult to assess our future viability. So this is similar to a forward-looking statement where Mullen is speaking to all new investors or to any investors that have been long on the company for a while now, just giving that word of caution that there is a significant amount of expenses, as we saw from a loss from operations standpoint, as well as where they're at with their revenue. They're going to need to scale up that revenue in the next few months in order to make this a viable operations. So I did list a couple of items. I'll talk about those at the end, some non-dilutive ways to raise capital. But let's go ahead and move on to the next bullet. We will require substantial additional financing to effectuate our business plan, and a failure to obtain this necessary capital when needed on acceptable terms or at all could force us to delay, limit, reduce, or terminate our product development efforts or other operations. So as Mullen mentioned, they have, as of September 30th, a little over 150 million cash on hand. We looked at their loss of operations month over month. So it is going to be important that they're able to identify some additional funding in the near future. So let's go ahead and read through the last section here. We have not paid cash dividends on our common stock in the past and do not expect to pay dividends on our common stock in the future. Any return on investments may be limited to the value of our common stock. So I definitely wanted to update you all on that. I know quite a few investors were interested to see if there was any kind of lawsuit settlement. Would there potentially be any type of dividend? Looks like, according to Mullen here, they would not be providing a dividend to any of the shareholders. Most likely they would take that money and reinvest it back into the operations to, again, scale up that revenue, which would help out with the overall earnings quarter over quarter and help them basically sustain that operations, and then hopefully in the next few months or few years become profitable. So I did want to talk a little bit about that second section that I mentioned. I want to read the third paragraph down. It says, our ability to obtain the necessary financing to carry out our business plan is subject to a number of factors, including general market conditions and investor acceptance of our business plan. These factors may make the timing, amount, terms, and conditions of such financing unattractive or unavailable to us. In particular, recent disruptions in financial markets and volatile economic conditions could affect our ability to raise capital. If we raise additional capital through marketing and distribution arrangements or other collaborations, strategic alliances, or licensing agreements with third parties, we may have to relinquish certain valuable rights to our product, candidates, technologies, future revenue streams, or research programs, or grant licenses on terms that may not be favorable. So basically, if they were to partner with certain groups, or if they took on certain types of licensing to kind of help them in the short term, that would definitely be impacting their long-term revenue. So if similar like Bollinger Motors went ahead and sold 60% of the controlling interest to Mullen Automotive, obviously now Mullen has that controlling interest, so some of Bollinger's revenue now is able to be realized on the 10K, as you saw on one of the previous slides where they kind of went over some of those revenue lines. So just want to put that out there. That's one of the things that they're concerned with. But if we went ahead and read a little bit further, it says if we raise additional capital to continue operations, through public or private equity offerings, the ownership interests of our stockholders will be diluted, and the terms of any new equity securities may have preferential rights over our common stock, and further may restrict our ability to obtain additional financing, even if we needed to continue operations. Further, the ability to fund our needs through equity issuances, warrants, or convertible debt is or may be limited to covenants in certain of our existing or future funding or other agreements. If we raise additional capital through debt financing, we would have increased debt service obligations and may be subject to covenants limiting or restricting our ability to take specific actions, such as incurring additional debt or making capital expenditures, or subject to specified financial ratios, any of which could restrict our ability to develop and commercialize our product candidates or operate as a business. So Mullen is definitely letting everyone know in terms of raising capital, if they do have to take funding in the terms of additional equity issuance or warrants, convertible debt, things of that nature, there is a certain amount of risk involved there, and there is a potential for dilution. So I listed just a couple of ideas, in my opinion, that Mullen could take before going towards the dilutive financing. So first thing, of course, would be to scale production. So as they're receiving this cash from Randy Marin Auto, go ahead and continue to purchase additional materials and continue to increase your assembly numbers or your delivery numbers, month over month, quarter over quarter. The second one will be non-dilutive lending. So this could either be through like an ATVM loan or through another lender. They could potentially do a partnership with a company, and they could offer stock, but they could offer that stock at the current fair market value. So that would be a great way to get a partner to purchase a significant amount of warrants as in a way of investment instead of just selling off those securities. Third thing would be lawsuit settlements or wins. So whether you go through arbitration, mediation, you reach a settlement, or you go to court and get a win in the case. Those are some other opportunities for Mullen to receive, some potential windfall of money that would definitely help them continue on their operations. Fourth item there is grants. So we know that they applied for a grant through the Department of Energy for the battery pack manufacturing. So that'd be a good $50 million increase in their free cash flow that they would be able to use towards the manufacturing of those battery packs. Next one would be partnerships. I talked a little bit about this as part of the non-dilutive lending. So yes, if the partners were to join with Mullen, if they believe in the company's plan and in their future commercial market, then they could potentially partner in terms of financing. And then if they would like to purchase actual commercial vehicles, whether it be vans or trucks, that could be all part of that arrangement made. Then the last one would be deposits on commercial vehicles. So we see a lot of deposits on consumer type vehicles, whether it be the Mullen 5 or just the Mullen 5 RS. As you saw, look at Tesla as a good example of another EV company that does offer deposits on vehicles. They had the deposits on the Cybertruck, as well as on some of the Model X vehicles in the early years of manufacturing of those. So just another way that Mullen could make some initial revenue or capital, I should call it, and they could use that to help scale operations and help increase that gross margin, which would help them improve on their profitability. So if you like this video and you'd like to see more, please consider liking this and subscribing. And then, like I mentioned earlier on, if you'd like to leave a comment, let me know what you liked about this video, what you didn't like. Let me know any other types of videos on Mullen that you'd like to be covered. And with that said, I hope you guys all have a great rest of the week. Thanks.